high yield dividend stocks in ASX to hold forever? This video is going to be broken into 3 parts. The first part, let's talk about 2 high yield dividend stocks I'm going to hold for the rest of my life. The second part, I want to explain why sometimes high dividend yield is a massive trap and how to distinguish between a trap and a really good dividend stock. And finally, we'll wrap up the video with an update on my portfolio and some market news to finish it off. Now, before we get started, did you notice there were ads before my videos? I am officially accepted into the YouTube Partner Program, which means when you gently smash the like button right there, you're literally putting food on my table. And for that, I just want to thank you for entrusting me with your precious time, and hopefully moving forward, I can create even better videos for you. So without further ado, let's go. Now, the first stock I have for you is Argo Investments. They are the second largest listed investment company here in Australia with over $6.3 billion in funds under management. Now, their investment objective is to maximize long-term returns to shareholders through a balance of capital and dividend growth. Here's exactly why I'm going to hold this dividend stock for the rest of my life and hopefully pass it on to my kids. Now, as of recording this video, their current dividend yield is 6.19% per year with fully franked dividends. And over the last 33 years, they have grew their dividends by 6.3%. And during this period, inflation is 3.1%. So that's pretty damn impressive. And unlike an index fund or ETF, where they have to distribute all of their earnings, LICs are a company structure with a board of directors, which means they can choose how much cash to hold within the company and how much cash to distribute as dividends. And having that kind of decision-making ability is really good for 2 main reasons. The first one is the dividend payouts over the years for you is going to be significantly more smoother. The second reason is that having the ability to choose how much cash is in the business at any given time, that allows them to play offense and defense when they see fit. And that's really important because sometimes opportunities are created because of, for example, the pandemic. There's a lot of buying opportunities, and if they have the cash to do so, they can capitalize on those opportunities. Now, the management cost is 0.16% per year, and that's probably as cheap as it gets. And with that kind of price tag, what you are essentially getting is cheap access to key sectors in Australia. Now, because of Argo's ability to navigate turbulent environments over the last 33 years and still grow their dividends by 6.3%, and together with a very affordable management fee structure, this is one of the reasons why I'm gonna hold Argo for the rest of my life, and hopefully at one point I can pass it on to my kids. For transparency's sake, 15% of my portfolio is allocated towards Argo Investments. Don't worry, I'll show you the full portfolio towards the end of the video when I do a portfolio update. Now, the second stock I have for you is WAM Research. Their objective is really similar to Argo, focusing on a rising stream of fully franked dividends combined with capital growth. And here's exactly why I'm going to hold this dividend stock for the rest of my life. Over the last 17 years, they have grew the dividends by 8.3%, fully franked. And as of recording this video, their dividend yield is 9.47% per year with fully franked dividends. That is absolutely massive, by the way. But what I like the most is not the yield, but the legendary man behind the dividend stock. In his late 60s now, Jeff Wilson have navigated the 87 crash, dot-com bubble, and the GFC. And he founded Wilson Asset Management in 1997 and now have more than $3 billion in funds under management across all of the listed investment companies Wilson Asset Management offers. The 2 main listed investment company in Wilson Asset Management almost doubled the market returns since 2000s. And similar to Argo, they can choose the amount of cash they can hold so that they have the ability to play offense or defense when they see fit. Not to mention the dividend payouts over the years are just going to be a lot smoother for you. But the performance and that growing stream of dividend income comes with a hefty price tag of 1% management fees per year and a 20% outperformance fee by whatever amount they outperform the All Ordinaries index by. Even with a hefty price tag, they have continuously delivered. So this is another stock I'm gonna hold for the rest of my life. Now, on that note, 47% of my portfolio is allocated towards WAM Research. And as I pointed it out in my Why New Investors Lose Money video, I definitely over allocated my capital to WAM Research, but I acknowledge that and I'm actively working towards allocating more towards Argo Investments, and hopefully that will balance out my portfolio. Now, if you want to check out that video, I'll leave a link in the description box below. At this point, I'm really hoping that you notice my main reason for holding majority of these dividend stocks is not just the dividend yield, because high dividend yield sometimes can be a massive trap. So let me explain. In order to calculate dividend yield, you need annual dividends over current share price. But the challenge is that share price is calculated in real time, whereas dividend announcements lags behind. So if the share price drops, the dividend yield will actually go up. And is that indicative of the dividends you're actually going to get paid? Probably not. If their share price went down because of an external shock like the pandemic, it's likely the company will announce a dividend cut shortly after to make sure they have enough resources to survive the tough times. Now, if the share price went down because of their earning potential have deteriorated, again, that dividend check won't last very long. So here are a few warning signs you need to look out for if you see a dividend yield greater than 8%. The first thing is their earnings growing year on year? Now, this specifically applies to individual dividend stocks and less so towards listed investment companies I have on this list. Now, if you're similar to me and you want to hold LICs as dividend stocks in your portfolio for the long term, what I'll look for instead is the track record of consistently growing and paying dividends, especially during recession events. What are they doing during recession events? Did they cut their dividends completely, or did they reduce it just by a little bit and then build it back up relatively quickly over the next year? And some additional things you can look at is whether the payout ratio for that individual dividend stock is greater than 100%. If their payout ratio is greater than 100%, that means they're paying out all of their earnings and some more as dividends. And that is not a very sustainable practice. And honestly, I will run away if I see a payout ratio greater than that. Now, the last thing you should also look at is whether the share price is trending upwards or downwards. Now, if the share price is trending downwards over the long term, you have to ask the question, why are they trending downwards over the long term? Like I said, if their earning potential has deteriorated at the point where it's no longer a really good business, and that is reflected in the share price, and with a high dividend yield, you know that's not going to last very long. So I would tend to avoid dividend stocks who've been trending downwards when it comes to their share price over the long term. So before we wrap up this video, I wanted to give you a quick update on where my Australian dividend growth investing portfolio is at, and also my US dividend growth investing portfolio. So this is the most up-to-date snapshot of my portfolio, and I have a good chunk of my US portfolio with stake that I'll show you in just a second. But on the 6th of June 2020, my portfolio is worth approximately 51,000 Australian dollars. Now, I have to say, I invested very aggressively during Feb and March, especially in Argo. So those positions have definitely benefited from the rally led by the banks and also resource companies that I'll also talk about in just a second. So what's really interesting over the last week or so is that the iron ore prices went up by 5.5%. And this is mainly driven by the fact that there was a lot of supply concerns coming from Brazil because they were hit quite hard by the pandemic. Now, Brazil is actually the second largest iron ore exporter in the world, just behind Australia. So we're definitely benefiting from our second largest exporter can't export iron ores. So that has pushed the iron ore prices up and benefited a lot of our resource companies. Now, the second piece of news I have for you shouldn't come as a surprise. Over the last couple of weeks, we're seeing a very strong rally leading by the banks, resource companies, and even Qantas. Now, a lot of value investors have picked up Qantas while they were down. And generally speaking, I think there's a lot of optimism in the market, which is really good because we need that for the economic recovery. But what I found to be more interesting is the Appen founder cashing in some of his shares on the 4th of June 2020. Usually when a founder CEO cashes in he or she's shares, it's an indication that they believe the current share price is probably the local maximum within a certain time frame. X is time and Y is share price. So after 4th of June 2020, this happened. After they announced that he was going to cash in some of his shares, the share price has corrected to about 29 bucks. And on Monday, we'll see what the new share price will be over the weekend. But that was pretty interesting to me. So this is my US dividend growth investing portfolio. And this is the most up-to-date version. Generally speaking, things have been really positive because of the unemployment report that came out recently. So I'll talk about that in just a second. But a lot of the stocks that I own in this portfolio, I plan to own them for like the next 20 to 30 years. I don't plan to sell them. I don't plan to trade them. I've done done a lot of research on every single one of these, and I plan to own them to give to my kids if possible. And on top of that, a lot of these stocks have benefited from the pandemic, which is really, really great to see. At the same time, there's a few outliers. So Dropbox, GoPro, and Nike, they're actually not dividend stocks. They're free stocks that are given to me whenever you use my link to sign up to stake. So on that note, if you want to try stake for yourself and wouldn't mind getting a free stock in GoPro, Dropbox, or Nike, I'll leave a link in the description box below. And I'm not sponsored by Stake. I just use Stake because it's easier and frankly more affordable to do so compared to other platforms. Okay, so before we get into the US market news, I just want to show you something that I use to keep myself motivated as a dividend growth investor. Now, what you see in front of you is basically me keeping track of how much dividends I should anticipate given where my portfolio is at. In May 2020, I anticipated just a little bit over $250 per month. Now, that doesn't sound like it's a lot, but it covers a few bills. And on top of that, together with compound interest over the long term, this is going to grow into a pretty big amount. Now, I haven't invested the June portion of my capital yet. So when I've done that over the next couple of weeks, I will keep you posted in terms of what my new expected monthly dividends are. Now, on the unemployment point, a report came out either on the 4th or the 5th of June, essentially saying that the unemployment rate fell to 13.3%. Now, the sentiment in Wall Street and also some of the economists was projecting that percentage to be much, much higher, anywhere between 19 to 20% unemployment rate. So, and frankly, I'm just happy the fact that people can go back to jobs, and hopefully moving forward into the future, consumers will feel safe enough to go out, to shop again, and to eat again. Now, the market has reacted very positively to this news, and Dow Jones and S&P 500 have rallied quite sharply to that. So a lot of good things are happening over the last couple of weeks, and I hope that will continue to help us recover much faster for the rest of the year. I'm just grateful that we are recovering. So thank you for watching this video all the way to the end. It really means a lot to me, and it also helps out my channel out a lot. Just so you know, a few of you have also asked whether I have a upload schedule. So my schedule is Thursdays and Sundays. And Sundays is when I do portfolio updates on my entire dividend growth investing portfolio. Also, some of you have asked, what is that number on the top of my thumbnails? That is essentially how much my portfolio is worth at a given time when I release the video. So I just wanted to use that as a way to track my progress over time so that you can see how my portfolio have grown the day when I started recording videos to now. So as usual, if you learn something new, make sure you gently smash that like button if you haven't already. Subscribe to my channel, click onto the bell so that when I release my next video on a step-by-step guide on how to invest in stocks in the ASX, you be the first one to know. And of course, Otto was with me the entire time. And until next time, see you very, very soon.